day and welcome to the DoubleLine Infrastructure Income Fund webcast. Today's conference is being recorded. At this time, I would like to turn the conference over to DoubleLine Product Specialist Colin Callahan. Please go ahead.
Good afternoon, and thank you for tuning in to the DoubleLine Infrastructure Income webcast, hosted by portfolio managers Andrew Su and Damian Kantz. Before we dive into today's webcast, some notable upcoming webcasts include the DoubleLine Closed End Fund webcast, hosted by DoubleLine Deputy CIO Jeffrey Sherman on July 25th. That will discuss our three closed-end funds: the DoubleLine Income Solutions Fund, the DoubleLine Opportunistic Credit Fund, and the DoubleLine Yield Opportunities Fund. And on September 14th, the DoubleLine Total Return webcast, hosted by DoubleLine CEO and CIO Jeffrey Gunlock and portfolio manager Andrew Su, that will discuss the economy, markets, and our outlook for the Total Return Bond Fund. To register for these webcasts, please visit doubleline.com. Outside of our webcasts, we also produce a variety of thought leadership available on our website. We recently published an article on the DoubleLine Infrastructure Income Fund entitled Creating an All-Weather Portfolio by Investing in Infrastructure Debt. The paper details how the infrastructure debt sector has demonstrated a demonstrated track record of resilience during recessions and economic downturns. Additionally, portfolio manager Ken Shinoda hosts a monthly video series, Channel 11, that reviews markets and macro drivers across varied asset classes. We also have two podcasts: the Sherman Show podcast, hosted by Deputy CIO Jeff Sherman and Sam Lau, and the Monday Morning Minutes podcast, hosted by portfolio managers Jeff Mayberry and Sam Lau, which is released every Friday afternoon, covering timely market commentary and macro events for the week. Lastly, PS Perspectives is a monthly video series hosted by our product specialist team, exploring DoubleLine's latest thought leadership on financial markets. These videos can be found on the DoubleLine Capital YouTube page. Moving on to fund offerings, the DoubleLine Infrastructure Income Fund is offered with two share classes: a retail share class and an institutional share class. Tickers, minimum investment amounts, and expense ratio details for both share classes can be found on the slide. Looking at performance, the Infrastructure Income Fund's institutional share class has returned 3.38% year to date through June 30th. And on the bottom left-hand side of the screen, you can see the fund's 30-day SEC yield of 4.45% for that institutional share class. And without further ado, portfolio managers Andrew Su and Damian Kantz.
Thanks a lot, Colin. Welcome, everyone, to the 2023 DoubleLine Infrastructure Income Fund webcast. We titled this webcast "The Road Less Traveled," as we've started to see increasing inquiries on this fund as investors become more concerned about the degradation of macro markets and are seeking an asset class that offers both principal protection and the ability to generate returns through income and capital appreciation. Historically, infrastructure has almost been exclusively in the domain of private markets, but at DoubleLine, we do offer this fund, BuildX, for investors to access infrastructure debt through liquid and public vehicle. Looking back to our previous webcast in July of last year, a few topics that were affecting markets and investor sentiment. Recession fears were still in the preliminary stages. Inflation was heavily impacting markets. And then other macro factors such as geopolitical and climate issues were all being dealt with. With this as a backdrop, we did implement some changes to the portfolio. We'll discuss that in detail during the portfolio review portion of the webcast. But looking at the table at the bottom of the page, it does show the fund has performed well versus its Morningstar peer group, going back to inception. And then more recently, 2022 was a strong year, finishing in the top 10% out of 600 managers. And so far into 2023, we are happy with our results so far, but continuously pushing for better returns. We'll start off by looking at some macro markets today. Recession risks became headline news a year ago, but consumer has been resilient, and this has really certainly helped to delay the onset of the recession. Here, we're looking at a number of business and consumer measures. First, let's look at the dotted black line, and that is going to be the average of all of these data sets, and this is trending upwards, so close to 1/2 of one standard deviation above the mean. So that is indicating some confidence amongst the consumer and businesses. But we do see an important component in the economy, the red line. This depicts the small business optimism trending convincingly downward, close to one standard deviation below its historical mean. Small businesses, large part of the U.S. economy, so we may see some flow-through effects to the broader economy if this persists or perhaps declines even further. Leading economic indicators have found some footing here from the rapid descent that really began in the start of 2022, but both the year-over-year change and which is the black line, and then the 6-month annualized return, the 6-month annualized change in LEI, which is the red line, are at levels seen only during recession. Even if we are stabilizing here, looking at the time series, we never see these levels during expansionary periods. The unemployment rate remains low, but it has been trending upwards, with the latest print coming in at 3.6%. If you look more closely at this chart, I do want to draw your attention to the red line. This is the exponential moving average. When the unemployment rate pierces the moving average, it can be a recessionary signal. You notice that there's been a number of quote-unquote false starts in the past, but we've never seen the unemployment rate rise by 0.5% from its low without experiencing recession. And so far, with this latest print, we are seeing we're about 0.2% from the low. So this data point is certainly worth keeping an eye on. The pace of rate hikes have caused a deep inversion in the yield curve. And here we're taking a look at the difference between the 2-year Treasury rate and the 10-year rate. It's widely acknowledged that the inversion of the curve is a signal for an impending recession, which is true, but the better indicator that that recession is nearing has been the re-steepening of the curve once an inversion has been achieved. The red shaded bars here do show previous recessions, and you can see that this certainly has been the pattern historically. I wouldn't call what we're seeing this week or even at the start of the end of last week a steepening just yet, but we are seeing some de-inversion. So yet again, another warning light to pay attention to as we are mindful of a potential recession in the future. Here, we're taking a look at a chart of real GDP forecasts year by year. And by looking at the purple line on the far right, which represents 2023, we did come into the year with growth forecasts near zero, but saw a number of upward revisions that have led expectations for about a 1% growth this year. This has come at the expense of the blue line on the right. And what it's doing is really pushing the expectation of a slowdown in GDP growth into 2024. Core inflation, it's been stubbornly slow to fall, but what we do expect is the trend to change towards the second half of this year. Core goods have been coming down again. Just reporting yesterday, used car sales, prices posted record decline. And that was a Manheim index. And we do see this as a tailwind. We also do expect shelter prices to fall and OER, which is owner's equivalent rent, to follow suit. This is a pretty significant portion of core inflation, and our expectation is that we will see some progress made towards Fed targets as we go into the remainder of the year. If that is the case, though, it does become difficult to believe the Fed will be able to get an additional 50 basis points of hiking in for the rest of the year. Although at this point, looking at market expectations, 25 basis points in July does seem quite likely. It's not just the Fed that will slow the economy down. Tightening and lending standards are beginning to have an effect already. Here we see the yellow line indicating how stringent lending standards are at banking institutions. The higher the yellow line, the more difficult it is to get the loan. Naturally, as availability of capital becomes scarce, defaults will rise. And you are seeing that the blue line here, which is the corporate default rate, increasing as lending standards tighten. It is our belief that tighter credit conditions could be equivalent to an additional 50 to 100 basis points of Fed hikes. which is another reason the Fed may find it difficult here to implement another 2 hikes in 2023. This is an interesting chart, and this compares the default rates of infrastructure debt to non-financial corporates through various cycles. The yellow shaded regions are recessionary periods, and we can see that during all recessions, and this goes back to 1999, we've seen fewer defaults within the infrastructure complex, and this is largely due to the critical nature of these assets and the inelastic demand for the services they provide. As we are approaching the possibility of another recession, if this relationship holds up, and we can't really find a reason why it wouldn't, infrastructure should be considered for investor portfolios. Shifting our focus next to energy and energy prices. On this chart, we can see oil's well off its peak in 2022 and bouncing around that low 70s range. I did see it at 73 earlier today. We are tracking China's reopening impact on final oil demand and seeing very aggressive summer travel season going on right now. At the same time, OPEC cuts will be implemented this month and potentially subsequent months. Typically, with a recession or macro weakness, this should dampen oil prices. But our base case is that supply and demand balance may slip into deficit later this year, and that should be supportive of oil prices at these levels. So do see some stability in oil prices in the near future here. For natural gas, very similar story of supportive prices, but for different reasons. Volatility we saw driven by Ukraine situation has subsided. Europe was fortunate that their winter was mild and short, which really helped gas prices fall from their very, very elevated levels. Today, the U.S. is a net exporter of gas, and with demand globally more reliant on non-Russian energy, U.S. exportation of natural gas should help maintain a stable supply and demand dynamic, and thus more stable pricing for natural gas. So similar on both oil and nat gas, we do see stability in the near future for both these commodities. Graphically, this chart here depicts the natural gas dynamic here in the United States. Production ramped up post-2005, and as production, which is the purple line here, exceeds domestic demand, which is the blue line on the top, that excess is now being exported, and certainly has all but eliminated the need to import energy in nat gas form. So you can see that in the green line dropping below that zero horizontal axis. As long as this dynamic holds, we do feel that nat gas prices will have reduced downside volatility on a go-forward basis. Looking next at renewable energy now accounts for about 20% of total U.S. power production. This is expected to grow, and on this chart, we see the three sources of growth within renewables, that's biomass, wind, and solar. We have investments in all three areas, and with technology improving and the utilization of storage, transforming this to an around-the-clock type power source, we continue to see opportunities in this space. Having said that, cleaner traditional power isn't going to be replaced by this technology. We do see both power sources, renewables and cleaner fossil fuel generated power coexisting in the future. With growing power needs, you're going to need grid modernization. And this is one of the larger capital expenditures within the power industries. On this chart here, we see a number of regulatory actions for grid modernization by state. The darker the shade, the more actions that have been requested. And this would include things such as energy storage deployment, utility business model reforms, and smart grid deployment. This isn't a one-way road here where CapEx is being spent and then sources of revenue will be identified later. Regulated utilities have the right to pass through expenses in the form of price adjustments to end users. They have a regulatory right to maintain their profit margins. Not many businesses out there can say the same. We do see these deployments as beneficial for the jurisdictions that they will serve. But also, as these deployments occur, we see this as a compelling source of investments for this infrastructure fund. Looking at the customer base next for power, we can see that residential, commercial, and industrial are all beginning to plateau. But transportation, which is at the bottom line, they're hugging that zero horizontal axis, has been essentially hugging that line since this data, as far as this data goes back. We do see transports as a big driver for future growth in the power space. And clearly, as that increases, the need for continued development and reliance on power infrastructure is going to only increase as well. Investments in charging, communication, and data infrastructure also continues to intrigue us as this transportation network continues to evolve. Looking at solar at the residential level here, we're taking a look at growth has been brisk. And while housing turnover or refinancings have resulted in prepayment speeds in the 15% range on an annual basis historically, we're seeing elevated mortgage rates today and also reduced mobility. And with that, we've seen solar prepayments cut to about a third of their historical levels. So significantly slower prepayments on these assets. And as rates remain high, that should be the case for this asset class. At the same time, as prepayment speeds are slowing, we are seeing increased analyzed losses within this residential solar universe. It'd be justified for anyone to be concerned that prepayment speeds are slow and loss rates are going up, but loss rates remain low. And I'll have to remind our listeners here that the positions that we own in this fund are very well insulated against losses. The average position is able to withstand more than 25% losses before seeing even a dollar principal loss. Historically, the highest that we've seen losses within the solar space has been about 4%. Currently, the universe is at 2.2. So still very low levels, but the positions that we own can take substantial losses before we're impacted at all. Next, looking at data center and telecom infrastructure, we are seeing a lot of growth in this area. Transactions secured by network infrastructure has been really prolific during the first half of this year, and the demand for data is only increasing. And we expect this issuance to continue to fund this. One thing that isn't as well appreciated in this space is the amount of power required to operate this infrastructure. On the charts here, we can see that growth in power consumption within the space is closely tied to power and telecom infrastructure. And we see the ecosystems with power and data telecom to be closely integrated and both to grow in the future here. As with many areas of infrastructure, the ability to pass through rising costs to end consumers does give infra the ability to insulate against inflation. Here, we're looking at rental rates for data centers. Rental rates were consistently falling going into 2020, and this is because more capacity was coming online, and then technological advances improved efficiency. But as power prices rose post-2021, operators in the space were able to pass through increased costs to end users. So really what we saw in this space is as power costs rose, and that's the biggest input cost for this sector, we really didn't see any fall off in revenue here, which is definitely a very big plus for this area. Last area or subject for me before I pass this to Damien to discuss the portfolio and our positioning. Here we're taking a look at the transportation sector, and we see global airline revenue segmented by both passenger and cargo. What's notable here is that in 2023, we're almost back to pre-pandemic levels with revenue. If you've traveled recently, you'll know that airplanes are fully booked, and many other infrastructure sectors, airlines have been able to pass through higher input costs, whether it's due to labor or fuel, onto the travelers. Revenue has been very strong, and we do expect to see that reflected in third quarter earnings with such a strong summer season that we're currently experiencing right now. Finally, looking a little closer at just air cargo versus maritime shipping, with airlines seeing such strong passenger demand and really high utilization across the board. Costs are at pre-COVID highs. While the opposite has really been occurring with maritime shipping. Demand for durable goods has been declining, and this has been alleviating the bottlenecks within the maritime supply chain. And despite this increasing competitiveness of maritime freight rates, we're not very constructive here and have found other sectors of infrastructure much more intriguing, actually have been legging out of some of these assets in favor of other sectors of infrastructure, which Damien will cover. I will pass this over to Damien now to cover the portfolio. Damien?
Hey, thank you, Andrew, and good afternoon. I will now cover the portfolio in more detail and address what we have done this year and how we are positioned. First, we'll start with the performance. Buildex outperformed its benchmark on all the period, 2Q23, year-to-date, 1 year, 3 year, 5 year, and since inception. Year-to-date, as of June 30th, Buildex outperformed the US Ag by 129 basis points. This outperformance was driven not only by sector positioning, but also by our sector rotations that we will discuss in later slide. Additionally, we're able to also benefit from extending duration during this bear flattening period. Since inception, Buildex outperformed the US Ag by 89 basis points. And during the first half of the year, we have seen a similar theme as last year, where our structured product allocation outperformed our corporate and EM allocation. For the 6 months outperformance in our structured product, it was mainly attributable to our aircraft exposures, which, as Andrew mentioned, has reached close to its pre-COVID level in terms of utilization rates. Also, our renewables and rail exposures were beneficial to our structured product performance. And on the corporate side, the big winners over the past 6 months were the utilities and the telecom sectors. These charts explain our positioning and the themes that have dominated the year for us. The left side shows our 2022 exposure, and the right side shows our 2023 exposure. In the middle, the number from 1 to 3 are the themes that we will be discussing in the following slides. We increased our utility and energy exposure at the expense of our transportation exposure in order to take a more defensive stance against the challenging macro backdrop that Andrew just depicted. Now, you can also see on this chart that utility is our biggest sector allocation and is our theme number 1. We increased this exposure from 16% to 29%. We are invested either in fully regulated utility or transmission and distribution, which are federally regulated. Then our second biggest sector allocation is transportation, where we decreased our exposure from 34% to 22%. And this is actually our theme number 3. Here, our exposure is mostly in aviation, where we have seen a big rebound post-COVID and have started to decrease our exposure as we felt valuation were becoming full. Similarly, we exited the maritime shipping sector due to full cycle valuation and also our desire to exit the more volatile sector as COVID-induced traffic and port congestion were alleviated. However, we have still maintained our exposure to railroads, port, and airports. On the telecom side, which is our third biggest sector allocation, it remained quite constant, around 21%. The portfolio here is in wireless towers, wireless providers, data centers, basically digital storage, which has grown rapidly in the past few years, thanks to increased data consumption and increased internet traffic. Our renewable exposures has also remained relatively flat over the year at 14%. Here we invest mostly in solar, where we see high growth potential as the level of adoption is still and keep rising. We are also keeping an eye on the battery sector and we would like to increase our participation in utility-scale solar battery deals. Lastly, this is the energy trade, which is our second theme that I'm going to discuss later. Here we slightly increase our allocation from 7% to 10%. We have been underweighting this sector for quite some time now. And here the portfolio is mostly in midstream contracted assets, which tend to be somewhat isolated from the commodity cycle. Now, let's start with our first theme, which is our utility trade. Over the last year, we have added 13% exposure to the utility complex, taking the sector allocation from 16% in 2022 to 29% in 2023. On the top of this page, we charted the credit spread volatility of the utility sector versus the Bloomberg US Corporate Bond Index. Over the past 3 years, utility has been less volatile than corporate on the spread basis, basically showing lower highs and higher lows. During period of market volatility, such as the recent Silicon Valley Bank collapse that happened in March 2023, we saw that the utility sector had about a third less spread volatility than the broader index. As Andrew mentioned earlier in his macro overview, we have been seeing red light indicator flashing for quite some time now. And in order to prepare the portfolio during the third quarter of 2022, we decided to add some robustness to the portfolio by moving away from the more volatile sector of infrastructure into more stable ones. We really like the attribute of the regulated utility in the US, as they are essentially a monopoly within a territory. Utilities are often seen as safe haven assets thanks to their monopolistic quality. This is well reflected in the spread volatility chart above. Additionally, utilities are poised to benefit from the increased capital expenditure associated with green modernization in order to accommodate the growth in utilization rates of renewable. It is important to note that the portfolio has no exposure to IPPs, independent power producers. We don't take any merchant power risk nor construction risk. And thanks to this trade, we were also be able to add some duration to the portfolio while benefiting from a less credit volatile asset class. We have also been adding to the energy sector over the last year. We've added about 3% exposure to that sector. At the top of this page, you can see energy credit spreads versus the Bloomberg US Corporate Index spread over the past 3 years. We have also added the oil price on the right axis. On the bottom, you can see our allocation to this sector over the same time frame. Our historical energy sector allocation is about 7% of the portfolio. We had underweighted this sector for quite some time, and we slowly started to add strategically into this space. In order to reduce the volatility of our holdings, we do not take the commodity price exposure. We are very selective with this sector. We have added exposure only to names that are fully contracted and or hedged. Additionally, to further dampen the volatility, we usually land on a fully secured basis. On the oil price overlay, you can see a more range-bound price action over the last year. We have been patient as we waited for interesting new projects with better entry points and attractive yield to add to this sector. We have picked up a few premium coupons in the LNG space where we have lent on a secured basis and where we have no commodity price risk and no volume risk. These trades also benefited from contracted cash flows with investment grade rated off-takers. We believe this type of opportunities exemplify the infrastructure debt trade, namely better yield, better collateral, and strategic stable assets that benefit from clear catalyst. Here the catalyst is the US becoming a net exporter of energy. Our last theme highlights the transportation sector. And it shows why we have been gradually reducing our allocation to this sector over the past year. At the top of this page, you can see transportation sector credit spread over the past 3 years versus the Bloomberg US Corporate Bond Index. On the bottom, you can see our allocation to this sector over the same time frame. Our historical transportation sector allocation is about 25% of the portfolio. During and post-COVID, the transportation sector was really struggling, not only due to the travel restriction and the lockdown measures, but also due to the reduced consumer and business activity. This can be seen in the spread charts at the top, where the blue line of transportation was consistently above the rest of the corporate index from June 2020 until January 2022. That meant that the sector was relatively cheap compared to the rest of the corporate. So we started increasing our exposure in January 2021 to take advantage of this temporary dislocation, taking our transportation sector exposure from 25% to 35%. So we added 10%. However, starting in September 2022, the transportation sector started to recover. And you can see this also in the spread relationship between transportation and corporate as they start inverting over that period of time. Meaning transportation was getting more expensive, which was a good time for us to start paring down our overweight exposure as relative valuation were normalizing. Over the past 9 months, we reversed out our transportation exposure back to 22% from the 35% overweight. Our sector rotations out of transportation into utility and energy has been accretive and strategic, with the aim of moving the portfolio into a more cautious stance. We are continuing to watch the various trends of the market to keep providing optimal risk-adjusted return while focusing on capital preservation and mitigating business cycle and commodity cycle. We are going to discuss our duration positioning here. As a reminder, duration is a measure of price sensitivity to the change in interest rates. The shorter your duration is, the less exposed you are to interest rate changes. Our duration has been consistently shorter than the benchmark, and we opportunistically targeted our lowest duration in the second half of 2022, just ahead of the Treasury rally. At that time, our duration was close to 3 years. We have since spent considerable effort to increase our duration by another 1.5 years in order to position the portfolio for a bull steepening event or a cool down of the economy and a potential pause or cut in rate by the Fed. As of June 30th, 2023, we are running the fund 1.6 years shorter than the benchmark. And in order to extend duration, we have been moving out of structured product, which tend to be shorter with amortizing profile, in favor of longer dated corporate investment grade papers. We intend to keep our duration range bound between 4.5 and 5 years for now, and are looking to strategically extend duration. This slide shows our asset class mix and some statistics. Infrastructure debt is a diverse asset class. We use a unique approach to investing in the space as we combine these various asset classes to obtain an optimal mix that enhances yield and duration. Currently, 40% of the portfolio is in structured product. These are asset-backed securities, which are securitized by pools of tangible assets. Think cell towers, data centers, solar panel, or aircraft. They tend to be shorter as they amortize throughout their life and carry a slight yield premium due to the complexity associated with their structure. Some of these unique infrastructure opportunities are only available through the ABS markets. 48% of the portfolio is in infrastructure corporate bonds. This is the more traditional way to invest in infrastructure debt sectors. Our counterparts are usually corporate entities that are investment grade rated. This lending is often done on an unsecured basis. Some corporate examples are integrated utilities such as Nextera, Dominion, or the telecom names such as Verizon or AT&T. And 11% of the portfolio is in project bonds. This is a slightly more specialized sector of infrastructure with a longer dated bonds where lending is done on a fully secured basis. On the table at the top, you can see that our weighted average life is shorter than the benchmark and that our average price is cheaper than the index. As far as geographic diversification, we are 83% located in the US, 10% in developed countries such as Australia, Canada, and Ireland, and 7% in emerging markets. The emerging market countries that we invest in have solid rules of law, and the projects are large and visible with direct links to the sovereign government. Think metro station or transmission lines, for example. We are not present in Europe as the currency is an issue. And as a quick reminder, we are a 40 Act fund, so we invest in liquid bonds that are US dollar denominated. With this slide, we want to highlight not only the quality of the portfolio in terms of ratings, but also our focus on providing investor with a portfolio that is secured by tangible assets. 52% of our portfolio, including cash, is secured. Having a lien on collateral leads to better outcomes in the event of a default, and it motivates management in a workout situation. As far as rating, we are running an investment-grade portfolio, heavily skewed towards single-A and triple-B ratings. We have been adding a small amount to our high-yield allocation during the COVID dislocation, and more recently, when we have seen high coupons for fully contracted high-yield assets. These trades have been beneficial to the portfolio. The title of this webcast is The Road Less Traveled. Infrastructure debt investing has been mostly reserved to institutional investors. However, this fund allows retail investors to gain exposure to this resilient asset class. As we have explained in past webcasts, infrastructure debt has strong defensive attributes. Lower historical default rate due to its inelastic demand and the strategic nature of the essential service that the asset class provide. Second, higher historical recovery rate, thanks to their long-term contract and stable cash flows, which usually command a higher cash flow multiple. And lastly, overall less volatility, which should help mitigate the macro headwinds that we spoke about earlier. Thanks to our ability to blend structured product with more traditional fixed income assets, we aim to provide investor with added security by collateralizing tangible assets, which enhances resilience across various market conditions. We believe that by investing in infrastructure debt, investor can create an all-weather portfolio. It is actually the name of an article that our team has produced, and we encourage you to read it. I will now pass back the presentation to Andrew, who will answer some of the questions that are in the queue. Thank you.
Thanks a lot, Damien. So a number of questions have come through the queue. Some of them have been answered just through the presentation directly, so I will kind of bypass those. One of the questions that did come in is asking, we've seen significant allocation movements over the last 12 months. Do you have any additional plans to alter allocations? And how do you feel about the fund's positioning going into potentially a top of a business cycle? I would say over the last 12 months, we have been really kind of preparing for this top of the business cycle type event, been making moves out of sectors where we feel like there will be more volatility into more insulated type infrastructure investments that should perform well in the event we do see a slowdown in the markets or a outright recession. So do feel very good about portfolio positioning here. But to answer the question, do we see significant allocation movements in the next 12 months? I do think that there are a couple kind of thematics that we are focused on. First and foremost, energy has been really a significant underweight for us. And as we see opportunities in this space, especially in the secured, if we have a secured ability to kind of access those types of investments, meaning we have first lien security on the underlying assets, we are interested in those. So potentially you could see some increases in kind of that sector or concentration within the portfolio. And then network infrastructure. This is anything from communication to data center, data storage type assets. We have been constructive on that. We do see that as a very strong growth area. And even in a slowdown in the economy, those assets will be heavily utilized. That's our expectation. So we'll migrate there as well. The one area that we may continue to migrate out of here is transportation. That's heavily cyclical. As the economy slows down, certainly could see decreases in utilization and volume and therefore revenue in those spaces. So have been migrating out already, but potentially could see a little bit more migration in that space. A question on global shipping. I do think Damien covered it, but just to be very clear, we've essentially almost sold all of our global shipping assets out. That has been a sector that has performed quite well through COVID, especially the positions that we held that were secured, that were amortizing and paying both principal and interest. But as spreads come in and we do potentially see utilization rates decrease in that area, we have been migrating out. So hopefully that answers the question. We're essentially almost out of completely of that sector. And then one macro question I'll just answer here, and it seems like we're going to be at the top of the hour, so we'll just conclude it with this question. It's a longer question, but I'll just summarize it. It's really asking about QT and slowing of the economy and potentiality of rising rates and how investors in fixed income should expect to fare in that type of situation. Now, I would say this, as bond fund managers, we have a number of levers at our disposal in order to mitigate risk and maximize the return. At the highest level, we talked about duration a bit. And if the expectation is that rates will rise, certainly can take an active effort to reduce your duration, and that will minimize the impact of rising rates on the portfolio. As a secondary basis, and certainly this applies to the infrastructure income fund, is that we do utilize securitized investments, and these are investments that are not only secured by the underlying assets and essentially privy to all the cash flow coming off those assets, but they also amortize and pay principal and interest along the way. So into a rising rate environment, if you do have assets paying both principal and interest, that is a good thing because you can take the principal pay downs that are coming in and redeploy it into higher yielding assets. So I do think that even if we do see higher interest rates here, the opportunities that we're seeing in fixed income, including infrastructure related fixed income, is some of the best that we've seen certainly in my entire career. So are very optimistic. We are very optimistic here about fixed income returns and also what we can provide our investors on a go-forward basis. With that, I'll just conclude the call here. Certainly appreciate everyone's time and support on this fund. And until next time, hope everyone stays well. Thank you very much.